I think private equity has grown a lot basically because of the performance of the funds. It's worth splitting it out between buyouts and venture because buyout funds are where a lot of the money has been going over the years, and the performance there has been good. It's beaten public market returns on general, net of the fees and carried interest they charge. But the returns to some extent have been going down over the years, still beating public markets but by less than they did in the past. Venture capital has been very much the opposite. It had a very bad 10 years after the dot-com bubble burst, but since the financial crisis, actually the returns have been going up and increasing amounts of money have flowed into venture. And in fact, in recent years, venture capital has been doing better than buyouts, which has been quite a surprise. And so I think ultimately the reason why the money flows is because investors make more money, have made more money out of private equity in general than they would have done if they'd invested in the stock market. Yeah, I think that there's sort of increasing evidence that wherever you are, against almost all benchmarks that I've seen, that private equity has delivered better returns. That's true if you just looked at the US market and compared to US public market indices like the S&P 500 or the Russell 2000, or if you focused on Europe and looked at European private equity against European markets. In fact, I think partly because the fact the European market is a bit less competitive and a bit less developed, the returns have actually been higher relative to public markets in Europe than they have in the US. Now, it varies a bit depending upon what index you look at and what your comparator set is, but that persistent outperformance has been surprising. And I don't know whether it will exist in the future, but certainly that's what we've seen in the past. So I think that the way that the private equity works, again, differs quite a lot between buyouts and VC. In the case of buyouts, the private equity fund will generally control the company, buy a majority or the whole company, and they will transform the operations in some way or other. There are very, very many ways you can do that. It can be that you have a buy and build strategy where you decide to really invest in the sector and buy new companies. It can be transforming management, taking an old tired management team and replacing it. They could have a completely different strategy for the firm. There's any number of different ways in which they can add value. And sometimes it works, sometimes it doesn't. On average, it seems to work. For venture, it's very different because you're working with entrepreneurs there. You're not in control as a venture capital firm. You're investing money and you're trying to support an entrepreneur. And I think there it's more about picking good deals, backing your winners, helping the entrepreneur decide what market they really want to operate in and how they pivot their business. And so I think that the things that venture capitalists do is very different from the things that buyout firms do. I think that's one of the big questions is, did particularly buyout firms benefit from the market conditions that existed for the past decade with extremely low interest rates? And there's no doubt that that is a terrific tailwind to have, especially when you're borrowing a lot of money, which happens in buyouts, but not in venture capital. So I think that you can see most of the impacts here coming through buyouts, but I'll mention venture in a minute. I think that it's worth remembering that buyouts did perfectly well in an environment with interest rates of base rates of 4, 5, 6% in the past, before the financial crisis. The thing that will need to adjust those valuations, that as you move from a zero interest rate environment into one where interest rates are much higher, valuations of risky assets must fall. And I think that is the process we're going through at the moment, that there isn't much activity happening here in doing this speaking in 2023, because those valuations haven't adjusted enough to make it profitable again. there's no doubt that companies will be valued at a lower level with higher interest rates. But I think that the private equity funds can still potentially make money in that world. I think venture is very different because venture had an undiagnosed bubble in 2021 where everything went crazy, valuations went crazy, the amount of money going in went crazy, and that isn't so much related to interest rates. It's just that there was a hell of a party and there's a hangover happening at the moment. So I think that venture will be less affected, but they've got this short-term hangover of 2021, which is still working its way out as we speak. In these sorts of times, I think the main thing I'm seeing with some private equity firms is that they're increasingly focusing on investing in private debt rather than private equity. I think there's much more focus on which bit of the capital structure of the firm people want to invest in. And some of the most successful private equity firms are now putting more attention in investing on the debt side. That makes sense because debt investing is becoming much more profitable now. If you've got base rates of 5% and you can charge another 5, 6, 7% on top of that for debt, then that can make it look very attractive relative to equity. So for the larger firms that can decide where they want to invest, I think the main thing I'm seeing is that there's a increasing focus on growing their debt business. For the other private equity firms that don't have that sort of capability, I think that they will just be, in a sense, having to look harder for companies which can handle higher interest rates and at lower valuations, because the valuations will have to be lower in order to generate those future returns with higher cost of borrowing, because that's the cost of capital to the private equity firms itself has gone up. In terms of regulation, there's always new suggestions coming around, whether it be on taxation or on transparency or the sorts of capital structure that private equity firms can use. The most significant piece of regulation that's going on at the moment, or is being debated at the moment, is in the US, which is where the SEC has looked at regulating private equity firms much more tightly, in particular the relationship, the amount of transparency they provide to their investors. So this is a very, as the name implies, it's a sort of private market. You don't get to see, as members of the general public, a lot of what's going on, but the assumption's always been that these are consenting adults who are coming to, and sophisticated investors who are knowledgeable about the terms of the deal between the investor and the fund. And I think the SEC has become increasingly worried that they can't necessarily rely upon that sophisticated investor to necessarily get the best terms out of the general partner, the fund manager. So the SEC is currently has proposed a range of quite wide-ranging increases in transparency for investors. And all I can say is that currently the funds are pushing back against that, and it will probably be tied up in the courts for several months to come. But that, I think, is the most interesting development. It might be a precursor to something similar happening in the EU, because there was a big push a few years ago, the so-called Alternative Investment Fund Managers Directive, which was not popular in the industry but was implemented, and since then it's been quieter in Europe. But I think it will never be quiet for long.